Bitcoin may not be rallying because the Fed turned dovish. It may be rallying because liquidity just got a little less tight. And that distinction matters a lot. Here's the big idea. The Treasury recently moved to buy back some of its own bonds, and while that may sound technical, the market is reading it as a signal that financial conditions are loosening. Now, the strange part is this. Bond yields didn't necessarily collapse in a clean, textbook way. Instead, the effect showed up where liquidity tends to appear first, in risk assets, especially Bitcoin. Bitcoin is incredibly sensitive to dollar liquidity, term premium, and stress in the bond market. If Treasury buybacks, fiscal operations, or market structure changes ease collateral pressure and put cash back into the system, Bitcoin can benefit fast, even if long-term yields don't move much lower. That's because Bitcoin is increasingly behaving like the market's fastest macro receiver. It's not just a speculative asset anymore, it's a liquid response mechanism for loose financial conditions. Think of it this way. When the plumbing of the financial system gets a little smoother, Bitcoin often reacts before traditional indicators fully catch up. That's why this matters beyond just crypto. It tells us investors are still hunting for assets that can absorb excess liquidity and trade ahead of policy lag. But there's a catch. This is an indirect effect, not a guarantee. If Treasury operations reverse, if the Fed stays restrictive, or if bond markets reprice higher real yields, Bitcoin can cool off just as quickly. So the message here is simple. This is bullish for Bitcoin in the near term, but it's bullish for a very specific reason: improving liquidity, not some broad macro breakout. If you want more real-time breakdowns of Bitcoin, the Fed, and the liquidity signals that actually move markets, hit like, subscribe, and stay tuned, because this is where the next big move usually starts.